JPMorgan Chase just took a $2.2 billion charge to acquire the Apple Card portfolio, and they're calling it patient deployment of excess capital. But is buying a struggling credit card business really the smart move? Let's break down what actually happened in the fourth quarter of 2025. In today's video, we're analyzing JPMorgan Chase's results for the fourth quarter and full year 2025. We'll examine revenue and profitability trends, what's driving growth across consumer, commercial, and investment banking, how that Apple Card acquisition impacts the numbers, management's outlook for 2026, and the risks investors should watch. Let's dive in. Here's what stands out. JP Morgan reported net income of $13 billion for the quarter. But excluding that Apple Card reserve, earnings were actually $14.7 billion. That's $5.23 per share, beating expectations. Total managed revenue hit $46.8 billion, up 7% from last year. That's strong growth for a bank of this size. Net interest income grew 7% to $25.1 billion, driven by higher deposit balances and more revolving credit card debt. Non-interest revenue also climbed 7% to $21.7 billion. Breaking that down, investment banking fees reached $2.3 billion, down 5%. But markets revenue surged 17% to $8.2 billion, driven by fixed income and equity trading. Asset management fees grew 15% to $4.4 billion on higher market levels and strong client inflows. Now here's the interesting part. If you strip out markets activity, net interest income grew just 4%. The real story is deposit growth and credit card balances, not rate benefits. JP Morgan is winning market share, not just riding the rate cycle. Non-interest expense totaled $24 billion, up 5% year over year. The increase was driven by higher compensation, including revenue-related bonuses and more front office staff, plus higher auto lease depreciation. But there's good news. The firm released $326 million from its FDIC special assessment accrual. The managed overhead ratio came in at 51%, down from 52% last year. That's solid efficiency for a diversified bank. Credit costs tell a different story. The provision for credit losses hit $4.7 billion, up 77% from last year. Net charge-offs were $2.5 billion, relatively stable, but the net reserve build jumped to $2.1 billion, and that's where the Apple Card comes in. JP Morgan agreed to acquire the Apple Card portfolio on December 30th, 2025. The deal includes about $104 billion in total credit exposure. That's $23 billion in drawn loans and $81 billion in unused credit lines. The acquisition is expected to close in roughly 24 months. JP Morgan took a $2.2 billion charge upfront to build reserves for expected losses. Management called this patient deployment of excess capital into an attractive opportunity. But here's the question. Is a credit card portfolio that Goldman Sachs struggled with really attractive? The bank clearly thinks it can integrate this better than Goldman did. Let's look at the consumer and community banking segment. This is where the Apple Card will eventually sit. Revenue grew 6% to $19.4 billion, but net income fell 19% to $3.6 billion. Why the disconnect? Banking and wealth management revenue hit $10.9 billion, up 7%. That was driven by higher deposit margins and growing asset management fees. Home lending revenue declined 4% to $1.2 billion on lower servicing revenue. Card services and auto revenue grew 5% to $7.3 billion. Card net interest income increased on higher revolving balances, but card income fell on lower interchange fees and higher origination costs. The provision for credit losses in consumer banking was $4.2 billion, more than doubling from last year. Excluding the Apple Card reserve, the base business saw flat reserves as macroeconomic updates offset loan growth. Net charge-offs were $2 billion, essentially flat. The card services net charge-off rate held at 3.14%. The commercial and investment bank had an outstanding quarter. Net income jumped 10% to $7.3 billion. Revenue climbed 10% to $19.4 billion. Here's what's working. Banking and payments revenue grew 4% to $9.7 billion. Investment banking fees fell 5% to $2.3 billion, pressured across all products. But JP Morgan maintained its number one global ranking with 8.4% wallet share for the full year. Payments revenue surged 9% to $5.1 billion on deposit growth and fee expansion. Markets and securities services revenue jumped 17% to $9.7 billion. Fixed income markets grew 7% to $5.4 billion, led by securitized products and rates. Equity markets revenue soared 40% to $2.9 billion, driven by prime brokerage. Securities services revenue climbed 13% to $1.5 billion. Asset and wealth management keeps delivering. Net income rose 19% to $1.8 billion. Revenue grew 13% to $6.5 billion, a quarterly record. The driver? Management fees climbed on higher market levels and strong net inflows, plus higher performance fees. Assets under management reached $4.8 trillion, up 18%. Client assets topped $7 trillion for the first time, up 20%. For the full year, the segment attracted $553 billion in net inflows. Return on equity hit 44% in the quarter and 40% for the full year. Let's talk about capital and liquidity. JPMorgan calls this their fortress balance sheet. The numbers back it up. Common Equity Tier 1 capital under the standardized approach hit 14.5%. Total CET1 capital reached $288 billion. The Apple Card acquisition reduced the ratio by 25 basis points under standardized and 90 basis points under advanced. Risk-weighted assets grew to $2 trillion under standardized, up 13% year over year. The firm returned capital aggressively. $4.1 billion in dividends at $1.50 per share, and $7.9 billion in net share repurchases. Over the last 12 months, the net payout ratio hit 82%. Book value per share grew 9% to $127. Tangible book value per share increased 11% to $108. CEO Jamie-Dimon's commentary gives us the roadmap. He highlighted continued economic resilience. Labor markets have softened but aren't deteriorating. Consumers keep spending and businesses remain healthy. But Dimon warned markets may underappreciate potential hazards. Complex geopolitical conditions, the risk of sticky inflation, and elevated asset prices. On capital deployment, management emphasized they're focused on investing for future growth. The Apple Card acquisition exemplifies patient deployment of excess capital into attractive opportunities. They opened 1.7 million net new checking accounts in 2025 and 10.4 million new credit card accounts. Wealth management households surpassed 3 million. Here are the 5 key takeaways from this quarter. First, core earnings power remains strong. Excluding the Apple Card charge, net income reached $14.7 billion or $5.23 per share. Second, markets drove outperformance. Trading revenue jumped 17% as volatility and client activity surged. Third, the Apple Card acquisition is a big bet. JPMorgan is taking a $2.2 billion charge now to acquire a portfolio Goldman struggled with. Success depends on integration. Fourth, capital returns continue. $8 billion in buybacks and $4 billion in dividends show confidence in excess capital. Fifth, management sees a resilient but uncertain economy. Growth continues, but inflation and geopolitical risks persist. If you enjoyed this analysis of JPMorgan Chase's fourth quarter results, please subscribe to the channel for more deep dives on financial stocks.